All right, welcome. Today we are diving into one of the biggest, maybe the biggest, questions in all of finance. It's a debate that's been raging for decades, and honestly, it affects pretty much anyone who's trying to grow their money. And it all comes down to this simple question, right? What is the absolute best way to invest your money? Should you try to be clever, pick the winning stocks, and beat the market? Or should you just buy a little bit of everything and just hang on for the ride? To figure that out, we really need to understand the two main schools of thought here. When you really boil it all down, it comes down to these two completely opposite philosophies. On one side, you've got active management. These are your stock pickers, the financial strategists who are trying to outsmart everyone else and get a better return than the market average. And on the other side, you've got index fund investing. This is a passive approach, and its goal is way, way simpler. Just match the market's performance. Don't try to be a hero and beat it. So here's how we're going to break it all down. First, we'll frame this whole debate. Then, we're going to peek inside the playbook for both active and index investors. After that, we get a really cool, rare look behind the curtain of the S&P 500 itself. Then, of course, the moment of truth, the scorecard. We're going to look at the hard data, and we'll wrap it all up with the one principle that, honestly, might change everything: discipline. Okay, first up, the great investing debate. Now, it's so easy to think of this as a big fight, right? Active versus passive. But what's interesting is some of the biggest players in the game, they don't see it that way at all. Check out this quote from a recent Vanguard research paper. They say, we shouldn't even think of it as active versus index. Instead, they see it as two sides of the same coin. I love that. It suggests these aren't enemies, they're just different tools for different job. So, keeping that idea in mind, let's explore that first side of the coin. The active manager's playbook. So, what does it really mean to be an active manager? Well, it's all about one thing: the constant, relentless hunt for an edge over the market. So here's the key thing to remember. An active manager is literally paid to make choices. They do the research, they analyze the companies, and they decide which stocks to buy, which to sell, and exactly when to do it, all in the hope of delivering returns that are better than just buying a simple market index. And look, this isn't just some abstract theory. Take a real-world fund, like this one from BlackRock. These guys are not just throwing darts at a stock chart. They're using their own proprietary models, incredibly complex quantitative analysis. They're even using AI machine learning, all to try and find stocks that they think the rest of the market has gotten wrong. This is a serious high-tech operation. And all of that intense work, it leads to a lot of activity. This number, this is the fund's portfolio turnover rate, 118%. That's huge. It basically means that in just 1 year, they bought and sold securities equal to the entire value of their fund, and then some. That's what active really looks like in practice. Okay, so now let's flip that coin over and look at the other side, the index fund strategy. And if active management is all about finding that one special needle in the haystack, index investing is about saying, you know what? Forget the needle, I'm just going to buy the whole haystack. The philosophy here is just completely different. Instead of trying to be a genius and pick the winners, an index fund just owns all the stocks in an index, like the S&P 500. The goal is simple: get the market's return minus a tiny fee. You don't need a crystal ball. You don't need a genius stock picker. And this is really where the rubber meets the road, right? Active funds have to pay their researchers, their traders, their supercomputers, and all that costs money, which means higher fees for you and, as we saw, super high turnover. Index funds, they're just tracking a list, so their costs are incredibly low, which means lower fees and much lower turnover. It's just a fundamentally different business model. Okay, so we've been throwing around this term, the benchmark, which for most of us really just means the S&P 500. But to really get what active managers are up against, you have to understand the rules of the game they're playing. And trust me, it's not as simple as you probably think. All right. Here is a myth buster for you, something most people get wrong. We all hear S&P 500 and we think, oh, it's just the 500 biggest companies in the US. Nope, not even close. The reality is, it's more like a very exclusive private club with some seriously strict membership rules. So just how tough is it to get into this club? Let's look at the official rulebook. First, you need a market cap of at least $22.7 billion. But that's just the start. You also have to be profitable not just this past quarter, but for the entire last year. Oh, and you just had your big IPO? Sorry, you gotta wait a full 12 months. And even if you check all of those boxes, a committee makes the final call. So the S&P 500 isn't just big companies. It's big, established, and profitable companies. All right, this is the moment of truth. We've seen the two strategies. We know the tough benchmark they're trying to beat. So how do the active managers actually stack up? It is time to check the scorecard. For this, we are not using opinions. We are going straight to the official scorekeeper, the SPIVA report from S&P Dow Jones Indices. And it does exactly what it sounds like. It pits active funds against the S&P indices. The numbers you're about to see are the percentage of large-cap funds that failed to beat the S&P 500. Okay, let's start with the last 5 years. Over that time, a full 86% of active large-cap managers fail to beat the index. But what happens when you look at a longer time frame? Well, it gets even tougher. Extend that out to 10 years, and the number of funds that underperform jumps to over 91%. And over the last 15 years, just look at this number. A staggering 98% have failed to beat their own benchmark. The long-term data, it paints a really, really clear, and for active managers, a very challenging picture. So, wow, those numbers are just overwhelming, right? Case closed, you might think. But actually, the story doesn't end there. Because there is one final principle that applies to both strategies, and it might be the most important one of all. Now, this is maybe the most important part, a fascinating finding from that Vanguard research. They found that investors in active funds are more than twice as likely to panic and sell when things get rough. The problem is, even the absolute best funds can have bad years, sometimes multiple bad years in a row. And giving up during those down periods, that is often the single most expensive mistake an investor can make. And this all leads to the final powerful conclusion from Vanguard. They say that whether you pick an active fund or an index fund, the real key, the final principle for success is the same for everyone: discipline. The ability to just make a plan and stick to it through thick and thin. So at the end of the day, the numbers tell one story, and it's a very clear story. But the real question, the one you have to ask yourself, isn't really about the math. It's about you. It's about your own psychology. The data shows us it's incredibly hard to beat the market, but it also shows it's hard for us as humans to simply stay the course. So let's ask the real question. Forget active versus passive for a second. Do you have the discipline to succeed?